We are here, actually here today, first thing in the morning, and we're getting everything set up here. I got my software all brought up. We're going to go into the demo mode, and we're going to take a look at the charts today. So, welcome everybody. Glad you're here. Glad to have everybody. What we're going to do is we're going to go through and this is the lab for our university class from last night. Again, my name is Lan Turner. And for those of you who are here who are not part of the university down at Utah Tech University, welcome. Everybody's welcome to come and hang out with us in the lab. And we're going to go through and talk about the different markets that we talked about last night at the university. So we talked about primarily the yield max funds. There's the yield max, there's the Granite shares, and we're going to talk primarily about the yield max, but we'll go look, possibly if we have some time, we'll go look at the yield max funds as well. And the markets are just dying, aren't they? Good thing we got protection, right? Good thing we got protection. All right, so let's come in and look at what some of these markets are doing. But the first thing I want to do is I want to go in and I want to kind of start from the very beginning. I didn't want to go and do a whole bunch of pre-work because you guys want to see how I do all that pre-work. So a lot of what we want to do is to set up our portfolio so that we can look at the markets that we're going to be trading. Now, we can be trading lots of things. We can trade, you know, all of the stock market. We can trade all the ETFs. And we're going to focus just today, we're going to just focus just in on the yield max funds, the high yield funds. And again, just because I'm excited about the high yield funds doesn't mean you have to be excited about the high yield funds. Okay. I like them. They're little, they can be a little troublesome because if you don't understand covered calls and you don't understand how they're doing what they're doing, you can not understand the concept of what's going on. And if you don't understand the concept, you're left in the dark a little bit. All right, so let's go and try and figure out what this concept is. And we talked about that last night. They're using covered calls, and the company's name is Yield Max. And we're just going to focus kind of on Yield Max today. All right. We can compare them to some other ETFs that we talked about and some other individual stocks. You can trade everything. You can trade them all. Just because we're talking about Yield Max doesn't mean that's the only thing you have to trade. All right. So we're going to come in here and we're going to pull up our browser. And this is Pit News Magazine, and this is the Misty or Winter article. And I wanted to show this to you. This is the article that we talked about last night in class on hedging. And so I would recommend that if you don't have Pit News Magazine, you come and get it and you read. Actually, you can just listen to, but you can read along. You click this little button and you read along. Okay. And then you can read along to the Misty and the Winter, which you learned last night. Winter is the hedge. The downside makes money when the market goes down. So if you own Misty, MSTY, which is making money when the market goes up because it's got covered calls, well, and then you think the market's going to go down, you can either roll your money into Winter and make money on the way down, or you can kind of just roll some of it into Winter to kind of give you a little protection. Either way, or you can just get out. There's nothing wrong with just getting out of the market. If you think it's going to fall, just get out. You know, that's kind of the biggest, usually the way most people trade. They don't hedge. They just buy low, wait for the market to get up. Think it's going to fall, get out. That's the simplest, easiest notion. All right. It's like, but Lan, I don't want to have a taxable event. I don't want to get out with a big profit. That's a good problem to have, right? I have to pay taxes on your profits. Well, if you don't want to, well, then that's when you hedge. But if you're going to hedge by going from Misty to Winter, you're going to have that problem anyway, right? You're going to have $10,000 in Misty, take $2,500 out and put it in Winter. Well, you're going to have to sell it. Taxable event, go put it into Winter. You take it out of Winter, put it back into Misty, taxable event, put it back into Misty. This is how it works. The government got their little paws in everything you do. They're your buddy, a pal. They want a little part of everything you do. Well, I don't want to pay them. All right, well then don't use Mr. Misty and Winter as your hedges. All right, or put it into a tax-free account. Do this in a Roth or a IRA or 401k or something. Then you can move them back and forth between those markets all you want, and there's no taxable event. All right. So if you don't want to have a taxable event, you're out in a normal market. That's when we use options. Then you just protect yourself with an option. You buy an option, and then as the market goes down, the option makes as much as the Misty is losing. And that's the idea. You're getting a hedge, you're getting an offset. And then when you take the profits on this one, well, you're going to have to pay taxes on it. Right? You still have to pay taxes on your gains on your option if you put an option on as a hedge. But if you just put the option on as a hedge, and you pay the insurance premium, the market goes down. Well, it keeps you able to sleep at night because you're not losing money. You're making as much money in the option as you're losing in the stock, or nearly so. I mean, it's based on delta, but that's a little bit beyond the scope of what we're talking about today. We'll do that in the options class to understand that, but it'll eventually catch up and be 1-to-1, okay, at expiration. At expiration, it'll be a 1-to-1. So you lose exactly the same amount of money as you'll make in the option at expiration. And so you can sleep at night. That's how it works. But if it goes up, well, then you lose the premium because you have a max amount of loss you can lose. You lose the premium of the insurance policy, but you know what? You drive $100,000 truck around, and if you buy an insurance premium, you don't cry every month because you didn't use the premium. You didn't use the insurance. Well, that means the market had to crash. That means that the big $100,000 truck had to crash. And so you bought an insurance policy to protect you against crashing the big $100,000 truck. You don't cry when you didn't crash the truck and then you had to pay the premium again. That's all an option is, just an insurance premium. You say an insurance policy to protect you against the market crashing. And so if you buy an insurance policy for this month, the market doesn't crash, you don't cry, right? You say, well, the market didn't crash. Good. I didn't lose my money. I didn't have to invoke my insurance policy. Now, one of the things about this is that we're talking about buying insurance, right? Well, as these yield max funds go, they're actually selling insurance. That's how they make money. It's selling a covered call. A covered call is an insurance policy in a sense. So we're collecting the premium as if we're paying the premium, right? We pay the premium for the insurance policy. On the other side, we're collecting the premium. So this Friday, I have a whole bunch of these yield max funds. I'm going to get a big paycheck. So that big paycheck's going to come in, and great, I made a bunch of money because I'm getting the premium. Now the market crashed on some of my funds. Well, that means the market went down. That means that premium is going to probably have to pay some of that to cover the losses on the market going down. And that's okay. That's the way the system works, right? It's like an insurance company. We'll talk about that on Friday at the university in class. So let's go over and let's just not get ahead of ourselves. And let's come in and we're going to go to yieldmaxetfs.com. That's the URL. Can you guys all see that? Yieldmaxetfs.com. So we're going to go ahead and we're going to go to their website. Let's pull this up full screen so you can see it nice big. They got a nice website. They got all kinds of fancy graphics and all kinds of pictures and all kinds of neat stuff. Makes your computer go real slow. All right, here is the list of our ETFs. Again, ETFs, exchange trade funds. Now, last night, remember, we talked about a single stock ETF. Look at all of them they have. Now, when just a year ago, when we started, they only had about this many. And so in the whole year, they got all these. Look at all of them. They got a whole bunch of them you can choose from. Airbnb, Disney, MRNY, that's your COVID shot. SMCY, who's that one? I'm not exactly sure. SMC, I'm just guessing. There's Microsoft. We can go through and look these all up. Okay, so there's several ways we can get this out of here. You just highlight them like that and see if we can't get. All right, we're going to see if we can't capture those. I'm going to show you a couple ways you can get these. I'm going to show you how to get these a better way than this. Let's try it though. We're going to just hit Control C, and we're going to pull up. I just kind of want to see if we can just help you figure out how to get these out without having to type them all. You can sit there and type them all, right? Of course, you can sit there and type them all, but who wants to do that? That's no fun. So then you hit there. Oh, look at that. How beautiful. That worked like a charm. We just took them right into Excel. Now, if you don't have Excel, there's a free version of Excel. You know that, right? Of course. It's a little bit harder to find. So these are the single stocks. Let's label this one, and we're going to come in here, and I'm going to show you why I'm doing it this way. Actually, you don't even have to do it this way. Watch that, because that came out. I wonder if we could. Let's try it. I mean, we don't know until we try. Let's bring up track and trade, because it jumped in there. We're going to come in here. We're going to create a new portfolio, and in the portfolio, we're going to call it Yield Max Single Stock ETFs. And we're going to say, okay. Now, because I was able to paste those into Excel, that leads me to believe I can paste them into track and trade. I'm just going to come right up here and to enter the symbol, and I'm going to hit Control V as in Victor, because that's the paste function in Windows, right? And sure enough, look at that. Boom, just like that. We didn't even have to type a single thing, and we didn't even have to go into Excel. I thought I was going to have to take them into Excel, clean them up in Excel, and then put them into track and trade, but nope. Didn't even have to do that. That's just as slick as a whistle. Didn't even have to go into AI. I was going to have AI go and do it, but now we don't even have to do that. So let's go back over to our fancy dancy little website here. So while that's loading, we can come and get the rest. Let's come over here. What's the rest? Well, here's the ones that are the single stock options income ETFs. These are the short singles. Now they don't have as many shorts as they have for the longs. Okay, these guys, now remember, these are all for trading covered calls. Covered calls is a bullish strategy. So if you think the market's going to rise and you would like to have them do covered calls and give you the profit coming out of the covered calls, you buy these. If you think the market's not going to go up, you probably don't want to buy these. All right. Or you want to get out of them. You can get out of them, or you can do all the hedging stuff that I talk about, which is a little bit more complicated. You can just get in and get out. Oh, the market's going up big. I'm going to get into this one and take all my dividends as long as it's going up. The market starts to go down. If it just goes down a little bit, I'm okay with that because the dividends will help cover the losses. Then the market turns and goes back up again. I'm going to keep getting all my dividends. It's great. As long as the markets are going up. If you think the market's going to crunch really hard, which is what we're going to talk about, how we figure that out in another class in the future, right? We're going to go do that. This is February, March, the first week of March. We're going to have another class down at the university, 3 days, and we're going to go through technical analysis where we know how to read the mathematical models, which are going to tell us the likelihood. Nobody knows when the markets are going to go up and down, but we're going to look at the likelihoods, the probabilities that the markets are getting into very extreme highs or very extreme lows. And it's at those levels that we can start to make our trading decisions. We don't want to be making trading decisions to get in and out of a market when markets are neutral or kind of just going sideways. We want to know when they're extremely low or extremely high, and the probabilities and the odds are in our favor. That's where we want to start executing our trades. And so if the market gets into an extremely high level, well, we don't want to be in these markets because they don't make money when the market goes down, okay, unless we hedge. These make money when the markets go down, but there's only 5 of them. So let's take these 5, and we're going to go Control C for copy. We're going to go back over to track and trade, and we're going to create a new portfolio just for these. And we're going to call these the Yield Max single stock short ETFs. All right. Now, again, there's only one stock inside the basket. It's a basket of, because an ETF is a basket of stocks, but in our basket of stocks, there's only one stock. And that's because they're trading it with synthetic, in this case, synthetic short positions and covered puts. All right, so we're going to come in here and put those 4 in there. Now, remember, these 4, you make money when the market goes down. So now we're going to come back over to here, and we're going to look at the rest of them. Well, we might as well put them all in here. Yield Max funds, fund of funds. So YMAG and YMAX. So YMAG, that's the Magnificent 7. So it's a fund of the funds. So it's going to be a YMAG is going to be a version of MAGs that takes dividends out, trades covered calls on MAGS. That's why they call it a fund of funds, because there's already a fund out there called MAGs, right? We talked about that last night too. So there's MAGs, but this one, YMAG, trades covered calls on MAGs, which is the Magnificent 7. So I'm going to leave that one out right now. We're not going to go into that one because I'm more interested in talking about some of these other single stocks. We won't have time to go into all these anyway, but this is what this one is too, YMAX. So there's another one out there. So it's probably doing we're going to have to go look at the details on that one. But YMAX is a fund of a fund. We have to go look at the details on it. Yield Max Ultra ETFs. This is SLTY and ULTI. Again, these are just Ultra ETFs. Don't know exactly what they do, but they're funds of funds. Again, I think that they're diversified funds. Salty, I know what Ulti is. Let's go look at Salty, SLTY. What I like to do is I like to come over into this program here. It's called FinViz. And I like to, when I don't know something about a stock, SLTY, I like to come here. And the reason is, do you like this lighter theme or do you like the darker theme? A lot of people tell me they like the lighter theme because it shows up on the YouTube better. For my eyes, I kind of like the darker theme better. I don't know. I don't know what's better for you guys. I'm trying to do what's better for you guys. Anyway, this is Salty. You can see it's going straight down. But Who knows whether that's making money or not? This program won't tell you that. We have another program for that. So let's come in here. But this program, what this does is it tells you what's in it. United States Treasury, Invesco Capital Management. Oh, it's investing in the Qs. QQQ. It's also got Carrier Global, Starbucks. I don't know why it's got percent. Let's see what else. Show all. What in the heck are they doing with this thing? It's got the Qs in there. 8% of it's just the Qs. That's probably to stabilize it. And then it's got all these other companies. Carrier Global, Starbucks, Zoetis, Target, Chipotle, GameStop, Charter Communications, Nike. So it's trading covered calls against all of these companies simultaneously and collecting the income and giving it to you. Well, you can see that's salty. And when we come over here, salty, we go back up to the chart itself, the net asset value, or the NAV, the value of the stock is going down, but it's giving you dividends at a rate of 36 cents per share. We don't know if the dividends are so big they're covering the downside. Remember, this is yield first investing. So the yield has to be high enough to cover that loss of the downside. And oftentimes the reason that goes down like that is because they're giving you so much yield. But you have to make sure that you're not getting into a stock, into a fund that's just right now during this specific market time is losing money, and losing money faster than the yield can pay for it. Well, how do you know that? Well, we go over to a little company, a little website called Portfolio Matrix, and we click in here and we say SLTY. What is SLTY? That's this fund. And it tells you that the gain is down 42%. The yield is 25%. Uh-oh. The markets of those funds that they're trading right now, of course, we all know the market's been flushing like a toilet. And this is relatively new. So bad timing. They started doing this fund exactly when the market started to tank like a flush like a toilet. So it's going straight down. So when the market turns and starts going up and all those funds that are in there start making money again and the market starts to go up, this might be something we could look at. But right now, no. Why? Because the gain is down 42%. That market's losing money. All those funds, all those stocks that are in there are losing money. And they're paying you the yield. They're selling their covered calls best they can. They're churning and burning in those covered calls. And they've made 25% on the covered calls, which is really great, right? Love to have those covered calls making 25%. But the gain, those stocks are losing money. So they only made 16%. Now, again, you're like, well, this thing sucks. It's lost 16%. Well, right now it does suck. It lost 16%. But it lost a lot less than everybody else who was in those stocks who didn't do it this way. I know it's just a consolation, but it's a big consolation. If you were out in the normal stock market, in the regular stocks, all right, those stocks that we showed on the list, right, these stocks down here, if you held these stocks, one of them being the QQQs, of course, the Qs are stable right now. That's what stabilizing as much it is. But if you held these stocks, Starbucks, Carrier Global, Zoetis, Target, a lot of people own those stocks. If you own those stocks, you'd be losing 42% because you invested in them with the Yield Max funds, which has the covered calls coming in at 25%. You only lost 16%. I know, you still lost 16%. Oh, this fund sucks. No, it doesn't. It only lost 16% when everybody else lost 42%. People look at these things, they don't understand the concept. Oh, that's salty. That's a piece of crap, man. That thing's got NAV decay. Look at it, NAV decay. NAV decay just means the stock market's going down. Stock market's going down for everybody. All right? The stock market's going down. Did you see when I pulled that thing up? When I pulled this up and we went to Apple, did you see Apple was on the screen? Let's just pull up Apple. I know it's not supposed to be in this portfolio, but we'll pull it up anyway. Apple flushed like a toilet at the exact same time as all those other stocks. Now it came back, but look, it's getting ready to flush again. Look at today. Man, it's down nasty today. Did you see Microsoft? MSFT. Look at that thing. If you were in that thing, 100 shares, man, you'd be down 25% just on that one. You lost $13,000 on 100 shares. $13,000 loss right there. That's big. That's a 25. It's lost 25% of its value on 100 shares. And then you're coming over here and saying, oh, well, this fund sucks because it lost 16%. Yeah, but the stock market in general lost 25%. Stock market of those particular funds lost 42%. The stock market went down 42% on those stocks. That's what that's telling you. But because you were doing the yield, first investing, because you put it into salty, you made 25%, so you only lost 16%. Would you rather lose 42% or 16%? I think I would rather lose the 16%. But I don't want to even lose that. So we're going to hedge. We're going to do some ways to protect ourselves from even losing that. Best way is just get out of the market when it's up here. If it starts to fall below these, some of these lines that we got in here, right? We got some lines. We talked about this yesterday, or actually the day before yesterday. See how these lines are in here. You don't have to be as fancy as doing Fibonacci and Elliott Wave and delta cone of probability and all that stuff. You just use these simple moving averages, 100 and 200 period moving average. As long as it's above the 100 period moving average, stay in. As soon as it falls below the 100 period moving average, if you think it's going to still stay up there and come dip down and go back up, you can use that as a buying opportunity to buy the dip. But if you think it's it's gone way up, it's been way up here, it's way up there, if you think it's going to flush back down for a little while, just get out. You don't have to hedge it, just get out, right? Because you made a whole bunch of money over here. Why are you going to give it all back? Just get out. Easier said than done. I know. But we do have some models that we try to follow. And I've showed you these models. I'll just pull this one up real quick once again. But we have models that kind of tell us kind of what to do. And we just want to watch the markets as they go through these models. What if it's not going through your model, Lan? Well, don't trade it then. Well, that's a simple answer. Market doesn't have to be. If it's not doing this, don't trade it, because this is what we expect it to do, right? This one, that's a bearish one. This is our bullish one right here. Different model, right? So this is the bullish model. It looks like to me, Microsoft has become the bearish model. It's the other model. It's not this one, because it should have come down here, gone sideways and started to go up from here. But now it's going down. So it's not this model. It's the other model. It's the one that went all the way down. So it's going to come down probably all the way down to where it was before. See that? And then maybe we'll get a accumulation and a rebound. But it's coming all the way back. February's a bad month. We call it the give back month, but that's just February. I mean, look at what it started clear back in October. And that little salty, you look at salty and you're like, that's just a crappy market. Yeah, because the whole market's crappy right now. The whole market's crappy. I mean, it was great. It's the greatest market in lifetime, right? In a lifetime, until it wasn't. And then it went back down. People think the markets can't go down. Oh, it's just going to go up forever. No, they go up and down. And so you just have to be smart enough to know to get out or stay in and lose 16% rather than 42%. That's what that's telling you. All right. Now they just happen to start this little fund, this little salty fund, right at the time, September. Look, right, that September. Go back to Microsoft. September. It's right here, right? They started their fund right here. And then you're like, oh, it's a crappy fund because it's going down. No, it's a fund designed to make money when markets go up. Robert saying dark is better. All right, we'll stick with dark then. I had somebody the other day tell me, a couple months ago, tell me white was better. So I was trying to do things with white. But if you guys like dark better, I'll go with dark. I like dark better. All right, I think I've kind of, but I think I've kind of beat that little horse to death. But the point is, you would never know that if you didn't have this software program. That's another point I'm trying to make. This little software program called Portfolio Matrix. This is the neatest thing ever. Why does Lan love Portfolio? Because me and my son wrote it. It's our program. Of course. We wrote it because nobody else is doing it. We have to know. We have to know how much of a fund is the gain and how much of the fund is yield. Now, if you come in and let's do JEPI, JEPI, one of the most popular funds in the world, right? JEPI for covered calls. Look at that. Now, JEPI is really cool. The gain was -2. The yield was 7.99 for a total gain in yield of 8% from this point here. So it had the big flush and then it rallied all the way back up. Okay. Now, if you cut off that big flush and say, well, I only got in right here in May. Oh, well, you were lucky. You earned in back here in March of 2025. You didn't have to suffer through that. But if you did, if you were there, well, it's 7.98%. And that's a covered call strategy, just like the yield max funds. The only difference is, remember, yield max, the way they do the long positions is with a synthetic long, so they have additional leverage. These guys actually go in and they actually buy the underlying stocks. Okay, they buy the underlying stocks. Now, JEPI is based on the S&P 500. So they buy the S&P 500, and then they give you the dividends off of the covered calls on the S&P 500. Now, the S&P 500 hasn't flushed, right? So if we go over and look at the SPY hasn't flushed. Didn't fall like Apple. Didn't fall like Microsoft. And a bunch of the other stocks that have been flushing out like toilets, right? But S&P is still strong. So if you come over and you go into little portfolio matrix, you can see the difference between the two. The gain was nothing. Why? Because they're giving it all to you as a dividend, which come out to be 8%. That's pretty good, 8%. And that's income. That's coming to you every month, right? That's income. So you got a 7.98%. Now you can come over here to this little program, and we can put in JEPQ or JEPI, JEPI, and portfolio matrix will show you this too. But see, it's got all these little dots right here. This is when you get your paycheck. Every month you get a paycheck from JEPI. And you can track that in portfolio matrix too. Portfolio matrix will track that. I just don't have it in my portfolio. We'd have to go put it in to show you the dividends. Here's the dividends right here. See, they're right there. 7%, 8.9%, 7.73%. They're just lines. They're not little circles. So there's your distributions right there. Sorry, I should have just showed them to you right here. Makes it easier. All right. That's JEPI. And the other one that we really liked was JEPQ, JEPQ. Let's go look at JEPQ. Now, again, JEPQ, come on, land, type JEPQ. There we go. So this is JEPQ. Now, JEPQ, this is based on the QQQ. All right. So they go out and they buy. You give them your money. You put your money into JEPQ. They go out and they buy. This is JP Morgan Chase, right? Big bank, not yield max. This is JP Morgan Chase. So JP Morgan Chase, you give them your money into JEPQ. They take it. They go buy the QQQ with it. QQQ hasn't really fallen either. If we go over here to track and trade and pull up the QQQ, see, it hasn't really fallen either. It's getting ready to fall. It's fallen today. Okay, but it's fallen below that 100-period moving average. Now, I thought it might fall a little sooner. I thought it might fall right in here. So as you guys know, I've told you a million times, I've got about $175,000 in this market to the short side. So I make money when the market goes down. Why? Only as a hedge, because I got a whole bunch of long positions in other markets, right? So I'm protecting my downside move by having some money in here just in case the market falls. And so this goes up. Is it 175,000? Is that what I got in there? I'll double check. Maybe it's more. No, I think that's right. Hold on. I'm just going to look real quick and see on this little tool right here. It's going to tell me. Where did it go? Go. I can't find it right now. Oh, there it is. How much do I have in there? To the short side. Oh, I have 279,000. Not 179. I have 279,000. $279,000 that will make money when this market goes down. And the reason I have it in there is because I have a bunch of long positions, and that's my hedge. If the QQQs fall, it'll help cover the losses of the other funds that I have long. Okay. So I'm using it as a hedged position. And that's where it's the probabilities. The probabilities got really high in there. And so I wanted to take that protective side just in case some of my other positions started to lose money, this one would help me make money. So it would just offset my losses. I'm not going to make money if the market falls. I just won't lose as much as everybody else. Okay, that's how that works. And I've got it into YQQQ, which is the downside, right? So if we go in here and say YQQQ, and if you look at YQQQ, well, over the last year, it's been terrible. Gain, negative 24. The yield, though, has been 22. So it's only lost 2%. That's a pretty cool fund. That's a pretty cool fund. If the market only lost, let's say you put $100,000 in here, $100,000, and it's supposed to make money when the market goes down in YQQQ. Think about that. It's supposed to make money when the market goes down, and you bought it right here and it went up. Well, you'd only lost 2%. Why? Because it lost 24% in gain because the market went up, not down. But the yield was so big, it covered all of it but 2%. So imagine what would happen if the market actually does go down. Now I get the 22% yield, plus I get a positive gain. What if that number was positive? This would be like 45% return if the market actually goes down. And it's only a 2% loss if the market goes up. So when I put $275,000 into YQQ and the market doesn't go down to make me money, well, it certainly doesn't lose me. It's not a big risk. So everybody's like, oh my gosh, Land put $275,000 into the market. If that thing keeps going up, he's going to lose a lot of money. No, I'm not. Why? Because I'm going to still make the 22% yield. Yeah, I might lose 24% of it over a year's period of time if the market goes explosive like it has over the last year. But if the market just kind of wanders sideways, I'll still make money. I'll still make the 22% yield. And even if this goes zero, that would be nice for me, right? On $275,000. I only lost 2% if I bought it, and I didn't do that. I mean, I thought the market was going to go up, so I didn't buy that. I bought it right up here at that red line. So now if the market goes down, this will go to zero, and this will remain at 22% or close to it. So I'll get 22 plus the 24 on the gain for about a 45% annualized return if the market falls. That's how it works. It's pretty simple stuff. All right, let's go back over to our portfolio. Where is our portfolio? Here it is. Oh, well, no, it's in this one here. All right, let's get rid of the stuff. Apple is not part of our Yield Max Short ETFs. Although look at Apple's getting ready to flush. Hope you don't have any Apple. If you do, get yourself some protection. All right, get a little protection. Dips, Fiat, Microsoft, that's not part of our delete. QQQ, that's not part of it. Delete. Look at the whole market's flushing out. SPY, what do you think the SPY is going to do? I wouldn't want to be buying into the SPY right now. I can tell you that. Delete. All right, winter. QQQ, YQQQ. Okay, these are all of our short markets. Crush, that's for the opposite side of Tesla. Dips, that's the other side of NVIDIA. If you think NVIDIA is going to fall, you would buy here. NVIDIA is not falling. In fact, go over and look at NVDA, NVIDIA. It's going up. It's going up right now. But it's been way up there. Everything else is falling. NVIDIA is not falling. It's just staying stable. Look at how long it's gone sideways. And so if you had NVIDIA, the NVIDIA stock, this whole time you made nothing. You had a little bit of a bump here. You got excited. And then it flushed right back down. And then you got scared. And then you got excited. Then you got scared. Then you got excited. Then you got scared. And then you got excited. Then you got scared. Right? Because you owned NVIDIA through here. And you're just waiting for that shoe to drop, for that thing to come flushing down. And it hasn't done it yet. Not like Microsoft, not like Apple, not like some of these other funds. Right? It's just staying up there. So let's go look at NVIDIA, because NVIDIA, although NVIDIA itself, let's go back over to the portfolio matrix, pull up NVIDIA, NVDA. All right. NVIDIA, well, it gives a dividend, 2 cents. So in other words, nothing. It gives 2 cents every 3 months on your shares that cost, roughly $185, 2 cents for every share. It's nothing. It's like 0.01%. It's telling you it's nothing. Okay, so NVIDIA doesn't give a distribution. Well, you can see it. It's right there. The gain was 40% last year. So from this opening point to here was 40%. So nice run on NVIDIA. The yield was 0.03%. So nothing. So you got a 40.51% on the gain alone. Now to participate in that gain, to take it and go buy yourself a new Tesla or something, you have to sell it, right? And then you wouldn't have it to gain next year. So that's the problem with traditional stocks, right? Not that that's bad. You sell your stock, make some money, buy low, sell high. But if we're going to come in here and we're going to go look to NVDY, now this is the yield max version, all right? So the yield max version, the gain went from here, look, it was way up here, and then the market flushed all the way down to here on the gain, down 31%, but it made 52% on the yield. That's the yield up here. See how much the yield? So you end up at the end, you still had 20. And that was paid to you. So you got that. Actually, you got this one here. You got the yield, 52%. That came back to you as cash. You got the 52%. Now, granted, the gain went down. So that's called because it started out way up here at this point here. And then it went down. Now, Len, why did it go down when the market was going up? Well, this isn't the market. This is the yield, right? This isn't the market. This is the yield. So it's telling you the yield. Now, this is reinvested drip dividends too. It's telling you what they reinvested. If you're not reinvesting it, it's not going to do that. So you take your money and put it back in, take your money, put it back in, take your money, put it back in. It would give you that yield. Okay, that's how this is working. But this would have come down like this. So because the market was giving you the yield, that's how a covered call works, but it wasn't actually making any money because, right, the market didn't go up the last 6 months. It just went flat sideways, didn't go up. So they keep giving you the yield. So it's called NAV decay. It's just actually what we call ROCC, right? Return of cash and capital. Now remember, we're doing this as a business, so you want to get your money back as fast as possible so you're at break even, so you don't have any out-of-pocket risk. So that's the name of the game, and that's what they're trying to accomplish for you. It's faster you can get your money back so you don't have any out-of-pocket risk. Everything after that's cash cow, gravy train. So this came in overall at a 20% return after we had a negative 31 and a positive 52. All right. So that's NVDY. So let's go back over. But we have a negative, a down. Remember, we have a down one. Let's go over here. That's NVDY. So we have, which one is the dips is NVDA. So this is dips. So dips is the downside. If you think NVIDIA is going to flush, you'd come and put your money into dips. So let's go to dips. Okay, dips. This is the opposite, right? This is only if NVIDIA goes down in value. So this is your hedge, or if you think market's going to go down. It lost 57% because the market actually went up. So makes sense, lost. But it still had a yield of 35%. Even though the market went up, they were still selling covered calls, and the covered calls coming in still made 35%. That's pretty cool, right? So the gain plus the yield is a negative 22. So if everybody thought NVIDIA was going to go down, which I don't know anybody who did, but I'm sure there were somebody out there who thought NVIDIA was going to fall, and they bought the short side. They lost 57%. Well, if you were in this market, this here, buying it, you'd have still made 35% on your yield, but you'd have lost 57% on your gain. So you'd have been down only 22%, where everybody else would have been down 57%. Not that I think anybody would have really been, I don't know. There's certainly people out there who might have held on to a 57% loser against NVIDIA. I don't know why anybody would do that. We can go look. You can actually go look at short interest and see, but it's beyond the scope of this class. See how many people are actually short, but that's short right now. We can see the history on it, though. We can see if people were actually losing 57%. Anyway, if you think NVIDIA is going to come down, you'd put your money in here, and then the gain would go to 0, and the yield would maintain something probably pretty close to that. All right, so let's go to the next one. That was the next one. This is Crash, CRSH. This one here is Tesla. So let's go look at Tesla. TSLA is the underlying stock, right? Tesla. That's what Tesla's doing right now. We played with this one. We put a little, we were goofing off with some orders. That's what that is right there. You see those lines on the screen. We bought some and we put a protective put in there to protect ourselves to the downside, right? That's what that is. So if the market falls, the max amount of money you can lose is between the two green lines. Okay? Now, a lot of people call that the spread. I try not to use that word because this little number here between the buy and sell up here, that's also called the spread. So if I call it the spread, you don't know whether I'm talking about this or this. So I call this I try to relate it to insurance and call it this is your deductible. All right, we're going to call it your deductible just to keep things clear. This is your deductible. You got in here, you put your insurance policy there. Therefore, anything below that green line on the bottom, you're not going to lose any money below that point, right? But you had to pay a $3,160 insurance premium to cover that 100 shares. Okay, so that's your deductible between there. Anything below there, you're covered. You got insurance for it. If the market goes up, well, you start making money, but the money you make has to pay for the insurance premium that you bought. You paid a $3,000 insurance policy, so you have to pay for that. And if the market starts to go up decisively, and you're like, well, I don't need that insurance policy anymore, you can take it off and get some of that $3,000 back. Okay, because that thing is insuring you clear out to here. It's got insurance all the way out to here. But if this market starts going up like this, there's no reason to hang on to the insurance. You can get rid of it until it looks like it's going to turn, break the little blue lights way up here. Then you can buy some more insurance up there against a downfall. And if you don't use it all, you don't use it all. Get it back. Get some back. Get some back. All right. So that's Tesla. And that's our little model right there that we put on to protect us to the downside. So there's Tesla. Let's see. So if we think Tesla is going to go down, we would buy Crash. I think that's a brilliant name for it. All right, Crash. So Tesla's been going up, right? Tesla's been going up. So Crash obviously is going to be going down because it makes money when Tesla goes down, not when Tesla goes up. So that's why it's been going down, because Tesla's been going up. It's the inverse. So let's go over to Portfolio Matrix. We're going to put in Crash. Let's put in Tesla first. TSLA. So that's Tesla. And you can see that it started out way up here. Then we had the big flush, and then it rallied all the way back up, and it's way up here. So we had a 20% gain from March to March, okay, February to February. We had a 20% gain. And then the yield is zero because they don't pay out a dividend. See, no little lines down here. No dividend. No dividend. So we got our 20% return. That's what we got in Tesla last year, 20% return. If you just held the stock. Now let's go look and see if we would have held the underlying Tesla TSLY fund. Now this is the one that sells covered calls against it. So you'd have had a loss of 42% on the gain, a 54% on the yield, which means they're taking the profits out, giving you the little pots of gold every month. But at the end of the month, at the end of the year, because we had a big flush here, and then we took out profits all along here, we have 12%. 12%. So 42% loss on the gain, 54% gain on the yield for a total at the end of the year of 12%. So you take out 54% along the way. You get all of your little pots of gold all along the way. So you can see what they are right down here. This little pot of gold was $2.89 per share. And you'll notice that they went every month back here. $2.31 per share, $3.29 per share, $3.80 per share. Now you can see the little lines. See these little lines? They're bigger and smaller. So you got your annualized distribution and you got your annualized versus the distribution. So $1.97 per share. So they went every month. See that? This is a real small one right there. They only did $1.50 per share. And then this was another really big one right here, $4 a share. Woo! That was a big month. Market really rallied, made a lot of money. So they had both the growth and they also had big dividends. So we love that, right? $4 a share. And then we come down here. Now they started paying out every week instead. Now, there's an article in Pit News Magazine about this. Jordan Black wrote an article about the switching from monthly to weekly. It's kind of like, why'd they do that? Pavlovian dog thing. I don't know. Everybody else is doing it, so they do it. So then Tesla stopped going up, right? It's not going up. If you go back over here to Tesla, it stopped going up right back here, kind of like NVIDIA, right? It's a little crazier, a little more volatile, but it stopped going up and it just gone sideways for that whole period of time. Popped out the top, got you excited, came back down here, got you scared, got you excited, got you scared, got you excited, got you scared, but nonetheless, just kind of went sideways. It's only been going sideways for the last like 1, 2, 3, 4, going into 5 months. It's not done anything. If you held Tesla right here, you're not making anything for 5 months. Nothing, not a penny. So that's caused this to happen, right? This is what's caused this to happen because we actually started out here. It went up and then it's come back down. So now we're at yield of 54. So total gain plus yield still positive at 12%. That's pretty cool, right? It's not as much as we'd like. We'd like to have seen Tesla keep going to the moon. And it might, a lot of people still have a lot of confidence in Tesla. They just stopped making two cars, right? They stopped making 2 of their older cars and they switched those lines over to start making robots. I had one guy that I was watching on YouTube said he went over to the Tesla factory and he was watching them make these new robots that they're making, right? He said in 5 years, these robots are so cool. He was in this factory and he saw the new robot. Now, Tesla lets us see little glimpses of them, but they don't really take them out and demonstrate them much for us, kind of keeping everything under wraps. They don't want anybody to know how great they are. And, there's some other really cool robots out there. But the Tesla has the ability to produce their robots in the millions. They can make millions of them. These other guys, they can't make them very fast. Tesla can make several million a year. These other guys that are out there have little robots. They can make maybe 100,000 a year. So Tesla can outproduce them 10 to 1 in production. And Tesla's robots are, this guy went into the thing and he said the robots are so cool. He says in 5 years, he says you won't even, you'll see, people will say, did you know Tesla made cars? What? I didn't know Tesla made cars. Because the only thing you'll know about Tesla is these robots. They said these robots are the coolest thing ever. They are so cool. I don't know. It seems a little dystopian to me, but we knew this world was coming, and it's better that we live through it and get to see it than to be dead and not get to see it. Wouldn't you rather be alive and watch the world go through this dystopian state of, oh my gosh, the whole world's changing, AI's taking over, robots are going to be everywhere, walking up and down the mall, out on the sidewalks, doing things, going for grocery shopping for you, going to be, oh, look, I called for the plumber and a robot showed up at the door and went in and fixed my plumbing. Or I might have my own robot. Oh, gee, I broke my arm. My robot comes and sets it for me and puts it all, fixes it for me rather than going to the doctor. Because you got your own doctor. The robot can be as smart as a doctor. That's what Elon says. So he says that eventually, you're not even going to realize or recognize that Tesla made a car. They're going to be, what? Tesla's a car company? I didn't know that. They're going to be so popular for their robots. Anyway, they've done that. They've made that switch. They stopped making 2 of their older car lines. They turned them off and they converting them over to make robots. And so like by the next year, he's going to have 1 million robots made. It's coming, folks. It's coming. In 2 years, you're going to be going to the mall and there's going to be robots walking up and down the hallway going shopping for people. Hey, will you go get me a new shirt? I need a new shirt. I need a size extra large. Can you go get me an extra large shirt? I need a couple of them. I like this style right here on this picture. Okay, I'll go get it. He goes down, gets in the car, drives. Is he going to get in the car? I imagine he'll probably go get in a Tesla. And he's going to drive the Tesla down, or else he'll call a robo-taxi. He'll sit in the back seat of a robo-taxi. There won't be anybody driving it. And he'll drive the robot down to Walmart, buy you a couple shirts, and come back and give you the shirts. How'd that be? That's kind of cool, right? Little Jetson stuff happening here. All right, that's Tesla. Anyway. That comes back to saying, do you think there's a future for Tesla and robots? You think this thing's going to go to the moon? Well, might want to invest in Tesla. If you think that that's going to be a big flop and a failure, well, then you could go into crash. and you could put your money in crash, because that would cause Tesla's stock to go down, and you make money when the market goes down, when Tesla goes down with crash. So let's go look at crash. All right, let's pull up crash. Now crash, Tesla's been going up, but so crash probably isn't going to be a big CRSH, probably isn't going to be a big money maker, right? But let's see how much it lost. Well, the gain was negative 60%. That's bad. You're like, oh, that's bad. Oh, yeah, it's bad. Tesla went down. All right. But the yield, selling covered calls, still made 53%. That's not bad. You still only lost 7%. And you were on the wrong side of Tesla the whole time. You only lost 7%, and you were on the wrong side of Tesla the whole time. The whole time you were on the wrong side of Tesla. And you only lost 7%. And Tesla went way up, right? Tesla had a nice run. So for that whole run, you were on the wrong side, and you still only lost 7% because you got the 53% yield. Now, if Tesla fell, this would go to zero. You'd get the 53 plus the zero, you get the 53% annualized return. That's how it works. All right, let's go over and look at the next one. What else? We got winter. Winter is MSTR. Now, MSTR is, let's pull it up here. MSTR is a company called, it's right up here in the left-hand corner, MicroStrategy. Now, MicroStrategy is a software company, but they buy so much Bitcoin. They have so much Bitcoin on their balance sheets, and they really believe in Bitcoin. They have so much Bitcoin in their balance sheets that their stock trades as if it's Bitcoin. So it's basically Bitcoin. All right. So what happened is I had a bunch of this back here, and I bought it clear back here. I bought MSTY. I bought Bitcoin, or not Bitcoin. I bought the MSTY, not the MSTR version. I bought the MSTY version. I bought it right here. And then I bought some more here, and I bought some more here. So my average price on this was right about here, right about at this little triangle. All right, that's where I had bought into this thing. And I had quite a bit. I had about like $100,000 worth. And that's where it was. And I made a lot of money. I was making money like I'd never made money in my life. This was brand new. This was a brand new fund. This is when we were trading, just getting started. See, this is back in October 2024. This is one of the very first things I ever bought with YieldMax. This is what got me excited about it. I made so much money, I couldn't believe how much money I was making. Even when the market was coming down, the money was pouring in faster than, so much faster that even when the market was going down, it was covering all the losses and still making me a big profit. And then, because I still had my average price was clear down here, when it came down, it started to touch it, but I was still making money. I didn't care. I was still making money. And then it started to go back up again. I started making more money. I was just like, oh my gosh, it's more money than I've ever seen in my life. I made so much money. It was just like great and awesome and wonderful. Came all the way down here, and I was just like, I ain't going to ever sell this stuff. I'm going to tattoo it to my arm, Misty, right here, you know. Oh, this is the greatest thing ever. Oh, I can't believe how much money I'm making. I'm so happy. I'm so happy. Even when it came way back down in here, I didn't sell. And I didn't sell in here. Why? I was making money. I was making money. I was making money. I was making money. I was still making money. Even though it fell, yeah, it started to fall. I was getting a little nervous. But I had an average price clear down here still. I didn't buy more. I was just like, well, it's, you know, I just stuck kind of right there. And it came down. It started to drop below my average price. Well, I didn't sell. Why? Well, I didn't sell because I'd never had to sell before. Even when it got back here, it stopped doing that. So even when it got back down here, I didn't sell. I just held on to it and turned and it went back up. So when it came out here, I thought, well, even if it dips a little bit, I'll still be making money and it'll still be covering my losses. And I'll just wait for it to turn and go back up. Well, it just kept going down and down and down, and it never did turn around and go back up. And so now I rode through this whole thing all the way down to here, and that's where I lost $100,000. All right. Now, did I really lose $100,000? No, I didn't lose $100,000. That's what it told me on my brokerage account, that I lost $100,000. That's why I tell you, your brokerage account doesn't take into consideration. It takes the dividends, puts them back in, and then if you lose them, it says you lost it here. I didn't really lose it there because I only put this much in back in the very beginning, and it grew to be huge, and then I lost 100,000 against 200,000. Right? So I still made 100,000, lost 100,000. I had 200,000. So did I lose 100,000? Yeah, I lost 100,000, but not against my original investment. I still made a whole bunch of money. What did I do with that money? Did I just lose it? No, I took it and I started other funds. I put it in different places. I made money, so much money in Misty. I took it out and I started Palantir. And then I made $88,000 in Palantir. So that $88,000 I made in Palantir came from the money I'd made from MSTR or MSTY, which is the yield max version. So it's all blended together, and you can't see it unless you have a program that tells you what that is. And that's what Portfolio Matrix does. Portfolio Matrix takes all those blended monies that you've got everywhere, keeps them all separate, knows how much money you invested in this particular one, what your seed money is, and then calculates the rest of the money and how much you're making and losing based on what those are, rather than blending it all together like your brokerage firm does. So your brokerage firm will tell you, you lost $100,000, Lan. No, I didn't, because I didn't ever start with $300,000. I started with $100,000. It went up to $300,000, and I lost $100,000 of the $300,000. So I really made $100,000. Plus, I took that $100,000 and put it over in 6 other markets that also made $20,000, $30,000, $40,000, $50,000. That's how I ended up with $400,000 at the end of the year, and still showing that I lost money. It's the weirdest damn thing. That's how it works, though. And we're going to talk about that in class on Friday. You have 2 sets of books. You have one set of books for the tax accountant, right? For the tax guy, for the tax collector, and you have one set of books for the bank. The one that the one that is your accountant, the one that's for the tax guy, that's your brokerage firm. The one that's for the bank, that's your set of books. That's Portfolio Matrix. Portfolio Matrix helps you with that. Your spreadsheet helps you with that. Look at my spreadsheet. I'll show you up. I also do a little spreadsheet just so I can help you guys. And to keep myself straight too. It's for me. It's for you. It's for me. It's for you. But we got Portfolio Matrix now. We don't really need the spreadsheet. So I haven't kept it up real well, because Portfolio Matrix is getting to the point where I don't need the spreadsheet anymore. But you can see the spreadsheet right here. So this says AMD. Let's do, since we're talking about, I don't know if you can see this. Let me try and blow it up a little bit. How do I make it bigger? View. Zoom. Let's go to 100%. That should help. Okay. So see this? You can see right here, I've got, where's my Tesla? Oh, it's not in here. I didn't have Tesla during this one. Okay, let's use Palantir. Okay, Palantir. This I put $100,000 in Palantir. But where did that $100,000 from Palantir come from? Well, it came from my profits in Misty. So it's like free money. I didn't go out to McDonald's and work for this money and put $100,000 of McDonald's money in there. This $100,000 came from money I made mostly from Misty. And I took the profits from Misty, and rather than putting them back into Misty, I put them into Palantir. Now, Palantir is flushing like a toilet right now, and it's very painful. But for me, it was it's all free money. Now, I'm trying to protect my free money. Just because it was free money doesn't mean I want to lose it. Of course not. But it's not part of my original investment that I put into the market. See, I started this whole thing with $476,000. It's right there. And that's my numbers right there. But $100,000 I put into Palantir, that actually came from Misty. So then we come in here and you see the market value is at 66. Well, that shows that I lost 34,000 of my 100,000. Why? Because the market started to go down. It didn't keep going up. But they were selling covered calls against it. And so they were making for me the yield. They gave me $93,000 in covered call money. So that's how I put 100,000 from Misty, which was free money. It's down to 66,000. So I lost 66,000. The pain or of that is $34,000 loss against my 100,000. But they gave me $93,000 in yield, covered call money. So I'm actually making $58,000 on free money that I never ever bought, that I never had to go to work for in the first place. So from profits from another trade, I made this money right here, $58,000. That's pretty cool, right? So that's how this works. This is how this spreadsheet works. So you have to kind of do this, because they don't do this for you in your brokerage account. If you go look at your brokerage account, they just take all these numbers and add them together and give you one number. Say you made or lost money. Okay. So they give you this number here, right? The total, they go for the NAV, the yield, and they give you this one number right here. But you really know that, hey, I started with 476,000. I've got 653,000. Okay. So you got this little spreadsheet that helps you understand that. And then you can come down here and you can see where you're at. You're sitting right here. Now, this spreadsheet is not up to date. It says I'm up right now at 47%, but that's not true. And the reason is because I haven't kept the spreadsheet up because I went and bought a whole bunch of put options to protect myself to the downside. Now my put options are making a bunch of money while my shares are losing money. So I'm hedged. I'm delta neutral. I don't have any loss below a certain level. But that's not reflecting this because I haven't got all my options tied into this spreadsheet. I haven't put them in here. I got a place for them down here, and this is not in here anymore either. I haven't updated my spreadsheet. That's gone. I took that off, and then I bought a bunch of put options, and so I need to list those all in here. And once I have all my put options in here, it'll show me a profit on my put options, which will offset up here in the top against my drawdowns here because I've got my hedges on. Okay, so this little spreadsheet. If you would like to have a copy of this spreadsheet, you get it for free when you subscribe to Pitt News Magazine. All right. So when you subscribe to Pitt News Magazine, you get this little spreadsheet for free. I've spent hours and hours. There's multiple models in here that you can use. You can use this model. 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 There's all kinds of different ways that you can look at the model, right, and do different things. You get all of them. You get all 4 of these. This is the one that's the simplest. It's called Land's World, and it's just the one that I use that tracks just the simplest stuff. This one here has got all the places for all the money that you've invested. You can see in here, this is for Tesla. This is Tesla. This one here is Bitcoin. You can see all the ones I've got in here. I got little pictures for you and everything. So you get this one, you get, and then you can just modify it and put your numbers in here and just use it as a template. So that's what that is. But if you don't want to do spreadsheet, you can just go get Portfolio Matrix, and let's go out to my dashboard, and you can see this Portfolio Matrix does it for you. We'll give that a minute to load while we're over here looking at the next yield max stuff. Let's go back over to what was the last one? We looked at crash, dips. This is NVIDIA. Coinbase is another one that they have a short position on. Now, Coinbase is like it's called Coin, COIN. That's the stock. So look at what it's doing. It's flushing out because Bitcoin's flushing out. Now, I've got an option on Bitcoin. I'm making money as Bitcoin goes down. Okay, I got a put option, and it's going up in value. And I finally stopped the losses. I got out of Misty. I don't have it, but I bought the put options to protect me to the downside. I bought some Bitcoin, put the option in there, and then when it didn't make money, I took the Bitcoin off and kept the options. So now I'm just making money as the market flushes out. But this is Coin. Coinbase is actually like the New York Stock Exchange, only for Bitcoin, for stable coins. All right, they call them. All right. So this is it's like it's an exchange for cryptocurrency, and it just keeps flushing down. So that's why they've got coin, and they've got the other side of that is fiat. And that makes sense. It's kind of a funny name, right? Fiat currency. So Coinbase is for cryptocurrency, and fiat is the name they chose to kind of show that. And so it's starting to go up. You can see it's going up. So coin is the underlying stock. Now, if you think coin is going to start going up in value, which I had a bunch of this too. I made a lot of this. I made a bunch of money through here, right? I had coin all through here. And so I dumped it as well, got rid of it when it started to go down. And I've got the short position on it. So I'm making money when it falls. So we can go in here, and it's Coney. CONY is the long side to this. So if the market goes up, you buy Coney. If you think this market's going to rise, see, and this is the one I had right through here. I had Coney, and I had some through here, and Coney was making enough money that even down through this bad spot through here, I was still doing okay. I wasn't making a bunch of money, but I was breaking even. And then through here, it started to come back, and I actually started to make money again. And then it came in here, and I just sold it. It just didn't really do a whole lot for me in Coney. But let's go look, and I'll show you how it turned out, because you can see it in the you can see it in the yield. There's my dashboard. Okay, so there's my dashboard, and you can see that's just how it turns out. That's what my positions are right now. You can see this is my income. You can see I'm sitting. Actually, it says the spreadsheet I said I was at 42. I'm actually at 58. So I was at 62. Now I'm only at 58. So that's a little, and actually, I think that the 62 is off the spreadsheet, which isn't exact. The spreadsheet's kind of a best guess guesstimate because you don't have all the Excel numbers. Portfolio Matrix actually connects to your brokerage account and actually has all the numbers. Okay. So it really does have all the numbers, all the exact numbers. So it's this is the real number right there. 58.25% is what I'm up in the last 12 months. So over the last 12 months, I was at 62. Now I'm at 58. So it's gone down a little bit, but I've stopped my losses because I got hedges put on, and you can see that in here. So this is all my positions for that market. And then of course it comes down a little bit farther. Now you can see my this is my IRA, and you can see it's at 67% with 235,000. So it's a 67% return. That's better than the 62 of the previous one. All right, so let's go back over here to, we're going to look at coin. So we're going to pull up coin, COIN, Coinbase. So coin is what's happened. So it went way up, and then it flushed like a toilet. So the gain is negative 48, and it's got no yield because this is the actual stock, the stock itself, and it doesn't pay a dividend. So it's just growth only. So you saw it, and it's going to be Bitcoin. It's basically going to go up and down the same as Bitcoin. So it's down 48% from the beginning, which was right here. It fell, rallied, made a whole bunch of money, kind of played around up here, and then it just flushed out all the way back down. So down 48%. That's what the stock's done. So now let's come in here and go to Coney, which is the yield max version. Now remember, the underlying stock lost 48%. Coney lost 34%. So it's lost, the gain was negative 80, but it gave you a yield of 45. So it only lost 34%. So it lost less over the period of time. But it took profits all along the way. It kept giving you money all along the way, but it ended up still losing 34%. Not real good, right? There was stages in here where it was making money, but this is all taking into consideration this great big huge flush at the beginning of the year. So if this great big huge flush at the beginning of the year, right, we go back over to Coney, it's taken into consideration this big flush right here. So this thing come flushing down, and that was just happened to be where Coney, that chart started right there. And so it catches all that big loss, and then it started to rally, made money, and then it came back, and now it's just flushing down. That's what Bitcoin's basically doing. So Bitcoin's just dying on the vine right now. It's just flushing like a toilet. So if you wanted to take the other side of this, that's what fiat is. So fiat is now starting to make money. So now we're going to come over to Portfolio Matrix and look at fiat, F-I-A-T. Fiat. And see, it's down 49%, but this is the short side. That's because losing money because the market was going up. Now the market's going down, so now this is coming up. So now the yield is 57, so it's up, making a positive 776. And if the market, it's made 57% on the yield against that 49% down. So it had a nasty down, right? Because you have to take into consideration this part here. Now it's coming in and starting to go up, making money. If you could zero that out, if that 49 was zero, because you didn't buy it back here and ride through this, you just bought it right here because you think the market's going to go down, so you buy here and it starts to go back up. Well, this is makes money when Coinbase goes down. You'd be making 57% if you had zeroed that out. But that big there, that's from this, right? It's that big flush out. So you go back 6 months. See, there you go. So we take that big flush out at the end where it started. So the gain is only 4%. You're like, that's not great. Yeah, but look at this. The yield is 38%. That's a 42% annualized return in the last 6 months. But when you look at it from a year standpoint, well, you got to take that big loss into place. Where you go just the last 6 months, that's 42%. That's why I say, if it looks like the market's going to go, buy low, buy when blood in the street, and it goes up, well, you can make a lot of money, 42%. But if you hang on to it and just give it all back, and the market comes flushing back down like a toilet, well, you're on the wrong side. That's why we have two sides. Make money when the market's going down, make money when the market's going up. This one makes money when the market's going down. The market's been going down, so it's up 42%. All right. That is our hedging. And that's what we talked about yesterday in our class. And I think we covered all of those. And of course, I'm keep going to the wrong one. So I'm not going to go back and go. That was our short hedges. Now you guys see how I do that, so you can go do it yourself, and you can do the rest of them. And you just do research. That's what you do. Decide which one of these you want to get into, which one looks best for you, and start small. I mean, start really small. I mean, $100, $500. Don't go put $50,000 into one of these things. Land's got $150,000 in one of these. I'm going to go put $150,000 into the one Land got into. Oh, that's not a wise choice. Just because you see that I've got money in one doesn't mean you should. I probably got into it a long time ago, and so I have reasons why I'm in it that might not be wise to be in it today, right? So don't do things just because you see that I do it. Just because I've got a lot of money in a short position on QQQ doesn't mean you should have a big position short on QQQ. That's just me having a hedge protecting all my long positions. Okay. So if Apple comes crashing down, Land doesn't lose a whole bunch of money. That's all that is. Don't say, well, Land's got a whole bunch of money in this market. I guess I better go put some there too. You need to make your own decisions, which is why you need to keep coming to these classes so you can learn how to make your own decisions. That's what we do here. We teach you how to make your own decisions, not to just listen to somebody else. Because if you're just listening to somebody else, they might have a whole different idea of why they're in a market than you. You might not realize that they got another side to the whole other thing. All right. So look at all these portfolios. I got lots of portfolios, and I need to come here and clean some of them out because we just keep making more. But Yield Max single stock ETFs. That's the ones right there that we just loaded from the website, which was over here. And we went here, and we went here, and we copied all those. All right. So we've got our portfolio. Come on, give it to me. I hate this thing. This website has too much fancy in it. And then it makes it so it doesn't work. Come on, fancy. I don't need fancy. I need work. I need functionality, not pretty stuff. Now it's not giving me my little thing. Come on, you dumb thing. I hate websites that do this. Why do you make a website that has so much fancy video crap on it that now you can't get to your... I hate that. That's just... functionality is more important than beauty. All right, so there we go. So that's all of the ones we got off the top. And then we got Yield Max right here. These are the ones we looked at. And then we looked at these down here, YMAX, Salty, Ulti, Dorsey Rye ETFs. I don't know what they are. They've got adding so many things. I got to learn about them myself. Yield Max Zero DT ETFs. No, these are Zero DTE ETFs. They're the ones that are trading options every single day. Yield Max Portfolio ETFs. Chippy. These we talked about. Chippy. Chippy was one of them. We could go look at GPTY, LFGY, Yield Max Target 12s. We talked about the Target 12s last night. Biggie. This is one we didn't talk about because I don't like it. It's brand new. It's only this long. So you got Biggie and Soxy. We like both of those. We like Chippy. Those are three that were really nice. And then you come over here, Yield Max Performance and Distribution Target 25s. Now these are new. See how these are the Target 12s, Biggie and Soxy, which we like both of those. The Target 25 is going to try and give a 25% yield, but I'm worried that the NAV won't always be going up. The NAV will probably go down, okay, because they're giving it all to you right now. So your NAV, the money you invested to them, they couldn't make the 25, so they're going to give some of your own money back. That's kind of what that works out. Not like it's a bad thing, but it's not necessarily a good thing. I gave you this money to invest, and now you lost it in the market, so you're just starting to give me my own money back. It's okay. Give me my own money back. I don't have a problem with that. I'll put it somewhere else. All right. It's called ROC and ROCC, cash and capital. They start giving you cash and capital. They give you profits and some of your own capital back. All right. Yield. There's an article by Pitt in Pitt News Magazine. I think it's in the January issue where Claire talks about that and how it kind of made sense in her brain. All right. So if you have a hard time understanding how that works, go read Claire's article in January issue of Pitt News Magazine. Lan, I don't have Pitt News Magazine. Well, why the hell not? Go get it. All right. Yield Max Europe. Okay, I don't know what that is either. We're going to have to look at some of these. These are new. They got so many new things in here, I can't shake a stick at them all. So they just keep growing and growing. This is a big company. I'm just one guy. So I don't have all the answers for all of these funds. It's just something they do. All right. JP Morgan Chase. You go to JP Morgan Chase's website, they're going to have a list like this too. They got all kinds of things you can invest in. That's why we need Portfolio Matrix. You go in Portfolio Matrix and you can put in all your stocks. You can put in all the ETFs. You can put in all the single stock futures. You can do it all right here. It keeps control of everything for you in one place from all of your brokerage accounts. So let's say you got 6 brokerage accounts. You go out and you hook them all into Portfolio Matrix, and it brings them all into this one location, and everything is put together, and you can see everything in one beautiful window. All right. That's why Portfolio Matrix is necessary. That's why we wrote it, because you get so scatterbrained. You can't keep a spreadsheet for all this stuff. You need something that knows how to do it all right here. That's why we're writing this software. And we're going to have a class not this Saturday, but the next Saturday, next weekend, not this weekend, next weekend on Saturday for people who have Portfolio Matrix. And we're going to go through and we're going to teach all about the little bit more advanced stuff in Portfolio Matrix. Plus, I'm going to talk about hedging. So we're going to have a little, and it's going to probably be down at the Hyatt. It's not going to be at the university. It's outside the university. And so we're going to be talking about Portfolio Matrix. Anybody who has Portfolio Matrix, if you own Portfolio Matrix, this seminar in St. George is for you. It's free. It's free for anybody who has Portfolio Matrix. I would recommend you get Portfolio Matrix. It's only $24 a month, just so you can go to the seminar, which is $175 a month, or a month, $175. So you come to that class, $175. You learn all about Portfolio Matrix. We're going to teach everything. It's for people who have Portfolio Matrix. So come and join us. Get Portfolio Matrix so you can come for free. And then if you have Pit News Magazine, my Pit News Magazine, if you come to that seminar, I'm going to buy you dinner for free. So if you have Pit News Magazine and you have Portfolio Matrix, you can come to the seminar, not this Saturday, next Saturday here in St. George, and you're going to get the free seminar. Starts at 1 o'clock in the afternoon. And then you're also going to get free dinner. All you can eat. We're going to go to a buffet. Get all you can eat dinner. I'm going to buy it for you if you have Pit News Magazine. Not, it's $39.95. So you can pay $200 and come to it, and just pay $200, come to the seminar. That's fine. Then you get the seminar and you get the dinner, $200. Or if you have Portfolio Matrix and you have Pit News Magazine, you get the whole seminar for free. All right. This is trying to show some appreciation to our clients who have Portfolio Matrix and who have Pit News Magazine. So that's what it's for. But I'd highly recommend you pick up those 2 tools so you can come and join us for free. Join the club. Join the club. We got so many things. When you have Pit News Magazine, I got so many things coming for you guys. I got all these little calculators that I can show you. I got these little calculators here. I got this little calculator here. I got this little calculator here. I got this little calculator here. I got so many calculators that you get when you come in and get Portfolio Matrix. Or not Portfolio Matrix. This is Pit News Magazine. These are all Pit News Magazine calculators. So all these little things are for Pit News Magazine people. All right. And I'm consolidating them and putting them all into one area. I also have a big course. I have a course for you that takes you through. So everybody who comes to the class at the university gets the course. All right. So you're going to get this anyway, but it's all part of the Pit News Magazine world. All right, guys, I've promoted enough, and we've come and we've played. And we've learned a little bit about some of these single stock ETFs, which are brand new. I like them. And just because I like them doesn't mean you have to like them. And they're just one part of my portfolio. I have all kinds of things going on, stocks and options and ETFs. And then I have some of these single stock ETFs. And so I'm teaching you what I like. But nonetheless, they're all just right here, all come together and managed for you in Portfolio Matrix, so you don't have to have a big spreadsheet. That's what it's all about. All right, guys, I'm going to let you go. That's all I have for you today. No questions, no concerns, then I'm going to let you go. We will see you, what's today, Thursday? Next time I will see you will be tomorrow night at the university. And then that's Friday night. And then our next class online will be probably, I don't know, we might do one Monday or Tuesday. Watch, because I don't know what my schedule is going to be for next week. We don't have any class. Oh, no, we do have class next week. It's Tuesday and Thursday class. So let's do class next week, or do Monday morning. We'll do Wednesday. Oh, we got to do Wednesday morning because we got a class on Tuesday, because next week classes are on Tuesday and Thursday. We only have 2 classes next week. Monday's a holiday. I think markets are even closed. Are they closed on Monday? I think it might be closed on Monday. I'm not sure. We'll have to look. Make sure you're subscribed to the channel so you get a notification when we go live. All right, so you can come and watch these things live. It's a lot more fun to be here live. So I don't, this is more fun to come live. But you can watch the recording. Recordings are good too. All right, guys. We'll see you next week. See you Friday at the university tomorrow night. Got one more class for that for this week. We'll see you then.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.